Ladies and gentlemen, thank you for holding, and welcome to the Q4 and full year 2019 DSP Group earnings conference call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question, you will need to press star one on your telephone. I must advise you that this conference is being recorded today, and I would now like to hand the conference over to your first speaker today, Tali Chen. Please go ahead.
Thank you. Good morning, ladies and gentlemen. I'm Tali Chen, Corporate Vice President and Chief Marketing Officer at DSP Group. Welcome to our fourth quarter and full year 2019 earnings conference call. On today's call, we also have with us Mr. Ofer Elyakim, Chief Executive Officer, and Mr. Dror Levy, Chief Financial Officer. Before we begin, I would like to remind you that during this conference call, we will be making forward-looking statements about our financial guidance for the first quarter of 2020, revenue growth in 2020, growth initiatives being on an upward trajectory and being primary revenue drivers, optimism about our engagement pipeline with strategic customers, recovery of Unified Communications segment in 2020, and momentum and growth of ULE in Europe and the US. We assume no obligation to update this forward-looking statement. For more information about the risks and factors that could affect the forward-looking statement made herein, please refer to the risk factor discussed in our 2018 Form 10-K and other SEC reports we have filed. Now, I would like to turn the call over to Ofer Elyakim, our Chief Executive Officer. Ofer, the floor is yours.
Thank you, Tali. Good morning, everyone, and thanks for joining us today. I hope that you had the opportunity to read our press release, which we distributed earlier this morning. I would like to begin by reviewing our results for the fourth quarter and the full year, then commenting on the progression of our business plan, and finally providing context for our outlook. In a short while, Dror will provide you with detailed comments about our financial results for the fourth quarter and the full year, and our outlook for the first quarter of 2020. Our fourth quarter results were ahead of guidance on most financial metrics. Revenues of $29.3 million grew by 12% year over year, while declined by 6% on a sequential basis. We ended the quarter with record high revenues from growth initiatives, reaching $19.6 million and accounting for 2/3 of our revenues. This accomplishment drove quarterly GAAP and non-GAAP gross margin expansion to 50.9% and 51.2% respectively. Growth initiatives benefited from solid momentum across all product segments. Smart Voice, Smart Home, and Unified Communications each grew by 21%, 63%, and 17% year over year respectively. With annual revenues of $73.8 million from growth initiatives, representing 63% of total revenues and driving gross margins to a sustainable level of 50% plus throughout the quarters, 2019 marks the year in which DSP Group succeeded in positioning itself as a leading voice AI and IoT technology company while maintaining solid engineering and financial discipline. We ended the year with revenues of $117.6 million, flat on a year-over-year basis, and despite the demand shortfall in the Unified Communications segment that we experienced in 2019, growth initiative revenues still increased by 15% year over year, surpassing the revenue growth level in 2018 of 12% and driving annual GAAP and non-GAAP gross margins to a record high of 50.6% and 51% respectively. Lastly, during the year we generated $10.5 million of cash flows from operations and ended the year with a cash balance of $131 million. We are thrilled by the momentum and acceptance of our new products and technologies and excited about the number of new engagements we have secured with strategic customers. At CES 2020 in January, the voice user interface and AI took center stage, and our solutions were an integral part of that. During the show, we successfully demonstrated our leadership and best-in-class technologies for voice AI and IoT. Moreover, we presented a record number of newly launched products by leading consumer brands, Tier 1 service providers, and leading OEMs, integrating our smart voice, smart home, and unified communications products across IoT, mobile computing, enterprise, and hearables applications. And here are a few examples. Today, our smart voice solutions are driving voice UI and AI in a broad array of applications, with over 80 products by 40-plus vendors, including Tier 1 brands such as Arlo, Facebook, GoPro, Logitech, Lenovo, Samsung, and TCL, that leverage our voice and AI solutions to design and bring to market highly differentiated and innovative products. In our smart home segment, 3 leading Tier 1 service providers selected our ULE product as their primary wireless IoT technology, including Orange in France and ADT in the US, and driving more OEMs and ODMs to take an active role in the growing ULE ecosystem. In the unified communications, we establish our leadership position by securing engagements with all of the top 7 leading enterprise OEMs, including Cisco, Avaya, Poly, Yealink, Mitel, ALE, and NEC. These strategic achievements, along with our exceptional pipeline of design engagements, solidify our success and validate that our growth initiatives will continue their upward trajectory and become the primary driver of our business going forward. Now, I'd like to move on to the business update by segment, starting with Smart Voice. During the quarter, we generated revenues of approximately $4.9 million from sales of Smart Voice products, representing a year-over-year growth of 21% versus the fourth quarter of 2018, while representing a decline of 1% on a sequential basis. We are delighted with the performance of the Smart Voice segment in 2019, reaching record revenues of $19.3 million and growing by 78% versus 2018. During the quarter, we continued to expand our product reach and engagements with leading consumer electronic brands, as demonstrated by the following new product launches. Facebook launched a highly innovative video conferencing system, its Portal TV, integrating our high-performance advanced audio and machine learning SoC. Leviton launched its Decora dimmer with Alexa voice services support, leveraging our audio voice SoC coupled with our voice processing algorithms featuring noise reduction, beamforming, and echo cancellation. The hardware and the algorithms are optimized for small footprint, far-field performance, and low cost. Nortec selected our Smart Voice product for its Numera Libris personal emergency response system, supporting long battery life while adding always listening features. These achievements, coupled with the recent wins in the smartphone market, including the newly launched Oppo K2 smartphone, continue to demonstrate the depth, strength, and diversity of our Smart Voice franchise and our ability to drive down power consumption while raising the bar on quality and performance for edge devices. At CES, we demonstrated how we are leveraging our voice expertise to create innovative AI solutions, as the next frontier in machine learning is now applied to voice. As more AI processing gets performed at the edge to address privacy concerns, reduce latency, and to make better use of available bandwidth, more efficient hardware and associated algorithms must be tightly coupled and optimized to meet consumers' requirements. We will continue to enrich our product portfolio with a suite of algorithms and hardware that address the rising need to create increasingly accurate AI solutions for edge devices for applications such as sound detection, proximity, acoustic beaconing, and more, all while maintaining the lowest power consumption. We believe that our smart voice business will continue to be a pivotal growth driver, powering a broad array of exciting new applications. Moving on to the Unified Communications segment. In the fourth quarter, we achieved revenues of $10 million, representing a year-over-year increase of 17%, while flat on a sequential basis. We ended the year with revenues of $38.1 million, representing a year-over-year decrease of 2%. And while we're disappointed by these results and attribute the revenue shortfall mainly to a delay in timing of orders originating from uncertainties related to trade war concerns as well as weakness in enterprise IT spending, we remain highly confident in the recovery of this segment this year. Propelled by the high volume design we secured into 2019 that already commenced mass shipment and is expected to contribute in a meaningful way to our 2020 revenues, as well as additional designs we secured, including a Tier 1 OEM and 2 other ODMs that launch new lines of IP phones with dual color displays, a Tier 1 OEM that launched a new series of IP phones for the UCaaS market to complement its on-premise portfolio. Based on our engagement pipeline, we are confident that we are positioned well for our performance and revenue growth in the Unified Communications segments this year. Turning to our smart home product line. During the fourth quarter, we generated $4.7 million in revenues, representing a year-over-year increase of 63% and an increase of 23% on a sequential basis. Full-year smart home revenues of $16.3 million grew by 12% year-over-year. During the quarter, we accomplished a milestone event for DSP Group and secured our first significant win in the U.S., which should pave the path for ULE's broad market adoption in the Americas. ADT, a leading U.S. security service provider, announced that it has selected our ULE technology as its primary connectivity for its new wireless security offering. The system, which was demonstrated at CES, includes a lineup of IoT sensors as well as a hub and camera. And moreover, some of these devices will also incorporate our smart voice technology. We are excited by the momentum of the ULE technology and expect this achievement to propel faster expansion of the ULE ecosystem with additional products and brands, as well as adoption by additional leading service provider. This momentum is also evidenced by the following wins and new product launches. Golden Mark selected our ULE technology for its new line of wireless smart home devices, including an in-wall dimmer, in-wall switch, plug-in dimmer, plug-in switch, and water leak detector. UMA launched a smart security keypad based on our ULE technology. The keypad allows control of UMA's smart security system that already includes a siren as well as a motion sensor, door window sensor, a water sensor to detect leaks, and a garage door sensor, all of which run our ULE technology. We're optimistic about the design momentum and growth of this product category in 2020 and beyond, on the heels of a strong traction for ULE both in Europe and the US. And now to an update on the cordless phone market. Our fourth quarter cordless phone revenue was in line with our expectations. Cordless revenues declined by 8% year-over-year to $9.7 million and accounted for only 33% of total fourth quarter revenues. For the full year 2019, our cordless business generated revenues of $43.9 million, representing a decline of 18% year-over-year, which is in line with the secular decline pattern of 15 to 20%. we continue to prudently manage this cash flow-rich business and reinvest its profit to fuel future growth in our well-performing growth initiatives. Now, for an update on our outlook for the first quarter. Taking into account the forecast we received from customers and our own assessment, we expect our first quarter revenues to be in the range of $28 million to $30 million. The midpoint of this guidance range implies a year-over-year revenue growth of 3%. The midpoint of the guidance also implies that growth initiatives should account for 60 to 64% of our first quarter revenues. To summarize, we are excited by the market response to our products and technologies, as well as the growing number of Tier 1 engagements. We believe that these accomplishments will solidify our future success on the heels of a strong pipeline of design wins, which are expected to contribute to solid performance and revenue growth this year. Now, I would like to turn the call over to Dror, our Chief Financial Officer. Dror, the floor is yours.
Thank you, Ofer. I will now review the income statement for the fourth quarter of 2019 from top to bottom. For each line item, I will provide the US GAAP results as well as the equity-based compensation expenses included in that line item, the expenses related to previous acquisition, and the exchange rate differences related to a new accounting standard related to long-term leases. Our revenues for the fourth quarter of 2019 were $29.3 million. Gross margin for the quarter was 50.9%. Gross margin for the quarter included equity-based compensation expenses in the amount of $0.1 million. R&D expenses were $8.8 million, including equity-based compensation expenses in the amount of $0.6 million. Operating expenses for the quarter were $16.1 million, including equity-based compensation expenses in the amount of $1.7 million and amortization of acquired intangible assets in the amount of $0.1 million. Financial income for the quarter was $0.5 million. Financial income for the quarter included $0.1 million of exchange rate differences related to a new accounting standard related to long-term leases. These exchange rate differences were excluded from our GAAP results for the quarter. Income tax benefit for the quarter was $0.6 million and included tax benefit resulted from changes in deferred taxes related to intangible assets and equity-based compensation expenses in the net amount of $0.3 million. Net loss was $0.1 million, including equity-based compensation expenses of $1.8 million, amortization of intangible assets of $0.1 million, exchange rate differences in the amount of $0.1 million, and the tax benefit effect of $0.3 million. Non-GAAP net income, excluding these items as just described, was $1.6 million for the quarter. With no GAAP earnings per share for the quarter, the negative impact of equity-based compensation expenses on the EPS was 7 cents. The positive income of the deferred taxes on the EPS was 1 cent, and the non-GAAP diluted earnings per share, excluding these items as just described, was 6 cents per share. Please see the current report on Form 8K that we filed with the SEC this morning for a full reconciliation of the non-GAAP presentation to the GAAP presentation. Now, turning to the balance sheet. Our accounts receivable at the end of the fourth quarter of 2019 decreased to $15.4 million compared to $21.6 million at the end of the third quarter, representing a level of 47 days of sales. Our inventory decreased from $8.7 million at the end of the third quarter to $7.5 million, representing a level of 47 days. Our cash and marketable securities increased by $10.4 million during the fourth quarter and were at the level of $131.3 million as of December 31st. Our cash and marketable securities position during the quarter was affected by the following. $10.8 million of cash was provided by operations, $0.3 million of cash was used for purchase of property and equipment, $0.1 million of cash received from exercises of options by employees, $0.2 $2 million was the change in the market value and amortization of marketable securities. Now, I would like to provide you with our projections for the first quarter of 2020. Our first quarter projections, including the impact of equity-based compensation expenses and acquisition-related expenses, are as follows. Revenues are expected to be in the range of $28 million to $30 million. We expect our gross margin to be in the range of 50% and 52%. R&D are expected to be higher than our run rate in the range of $10 million to $11 million. For the remainder of the year, R&D expenses are expected to be back to the level of $8 million to $10 million per quarter. Operating expenses are expected to be in the range of $17 million to $19 million. Financial income is expected to be in the range of $500,000 to $700,000. We do not expect to have any taxes on income or a tax benefit for the quarter on a non-GAAP basis. And our share outstanding is expected to be in the range of 24 million shares to 25 million shares. Our first quarter projections include $0.1 million of amortization of intangible assets. Our first quarter projections also include the following amounts forecasted for equity-based compensation expenses. Cost of goods sold include $0.1 million. R&D expenses include $0.7 million to $0.9 million. And total operating expenses include $1.9 million to $2.1 million. And now I would like to open up the line for questions and answers. Operator, please.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you wish to ask a question, please press star 1 on your telephone keypad and wait for your name to be announced. You can cancel your request at any time by pressing the hash key. Once again, it's star 1 to ask a question. And your first question comes from the line of Matt Ramsey from Cohen. Please go ahead. Your line is open.
Thank you very much. Ofer, it was obviously at CES as well. Great to hear about the ADT design win, and it seems like ULE is starting to get a little bit of a foothold. Maybe you could talk a bit about your expectations for the size of that design win as it rolls out. And then secondly, if I'm not mistaken, I think it's on their DIY platform, and maybe you could talk if there's opportunities on sort of the mainstream platform at ADT as well, and what the differences might be between their mainstream platform and the DIY one. Thank you.
Hi, Matt, and thanks for your question. So relating to the ULE momentum, indeed we are excited. For the last couple of years, ULE was a phenomenon that was mainly a European one, where we were mainly addressing and designing the technology with leading both security and telecom service providers, and today have both Verisure, which is part of Securitized Direct, the entire smart home, Magenta smart home of Deutsche Telekom, and also Maison Connect and Maison Protégé, which are the smart home and secured home of Orange, that are all based on the ULE technology. And actually, during 2019, we've made significant efforts to market and promote the technology in the U.S. And we believe that the technology's unique characteristics in the form of its natural support for voice, and voice is a key requirement for the security service providers. It is today a very important use case that will be deployed and used by all major security service providers. And when we look at this domain, we do see, in a way, two different markets that are today addressed by many different security vendors, both coming from the do-it-yourself. This is the ability to purchase a security system, basically a complete security system in retail, install it, subscribe to a certain level of service with that brand and get a certain level of capabilities with respect to home monitoring and the ability to have access to all kinds of additional services versus the traditional professional security market. And when we look at a market like the U.S. with about 120 million households, we see a great opportunity in security for ULE, for our products and technologies, including smart voice. And we believe that there will be a continued growth in this market by the adoption of more DIY as well as the existing professional security. We definitely see today that the DIY security market is burgeoning, and we see a lot of activity and a lot of new brands that are addressing this market initiative. And there's also, of course, the professional side, which is handled by fairly stable and significant service providers such as ADT. From the expectations point of view, I would say that it is still too early to say what the impact would be, but we definitely have expectations to see that being a driver in our smart home revenues this year. As you could understand both from CES as well as from the prepared comments, that each system is shipping with numerous ULE chipsets that are basically existing in almost every sensor, as well as in many of the sensors smart voice capabilities. So the dollar content here is fairly rich, and we do expect also to see the volumes. This product is now hitting retail, and we will of course monitor it very closely and try to provide you with as much information as we can. But in addition, we are also hopeful that we will see, following the bellwether type of service provider that has chosen this solution for the DIY, that there will be also further opportunities to penetrate also the professional side, as well as the ability to engage and leverage what we have done so far and what we can provide this market with this natural support for two-way voice activation, a lot of AI capabilities on the edge. We believe that this will be very highly applicable to many other participants in this market, and this is definitely part of our operating plan for the next 2 years. So we are very excited about the momentum, and I think that you've seen a lot of that at CES.
Thanks, Ofer, for all the detail there. As my follow-up, Dror, I wanted to ask about gross margin. Obviously, mix helps, but I remember when we were having the conversation of how to get the company out of the low 40s, and now you're in the low 50s. So well done on that front. I wonder if you could give us some commentary going forward, how you think margins might trend, and maybe remind us of the collection of your growth businesses. How far above the decked business are those? Just a separation of gross margin there on mix would be helpful. Thank you.
Yeah, sure. Thanks for the question, man. So first of all, as you saw also, when you're looking at the first quarter of 2020, you already see that the midpoint is at 51%. That is better than we were in average in 2019. So we are already looking to improve margin, and we believe that when we look throughout the year, we can even improve this number to maybe something which is like closer to 51, 52. Overall, as you rightly indicated, there are two factors. The first, this is like the mix of the products where revenues, and I would say like unified communications, smart voice, and also smart home tend to have better gross margin in the causes, as we see that from year to year, and this is also something that is demonstrated in our presentations. we see that the proportion of these growth initiatives increased. We also see that margins went up, as I said, from 40-something% to about 50. This is one thing. The other thing that we expect to see in 2020 is growth of revenue. So a portion of our gross margin or the cost of goods is also fixed. And once revenue grows, this proportion of the fixed expenses decreases. So we also expect this to have some impact on improvement on gross margins in the first quarter and also throughout the year. These are, I would say, the two main factors, the mix and the level of revenue.
Thanks again, guys. Appreciate it.
Thank you. And your next question comes from the line of Jason Schmidt of Lake Street. Please go ahead. Your line is open.
Hey guys, thanks for taking my questions. Just want to start on the unified communication segment. I know excess inventory in the channel really impacted 2019. Do you think that inventory is now cleared out though?
Hi Jason, so if I understood correctly, your question was on the excess inventory that we saw early last year or even fourth quarter of 2018, whether this has cleared or not. So based on our understanding about the market dynamics, 2019 as a calendar year was quite challenging for this category. As you accurately mentioned, we started the year with this pile of inventory that originated from the trade war concerns and the need to perhaps get goods outside of China and have them offshore so that they won't be subject to any future tariffs. And then during the year, these concerns continued, and actually in October, the tariffs were supposed to hit this category, and at the end of the day, there was a deal that was signed, so in a way, these tariffs never really took place. But we also saw during 2019 a much slower IT spending that also hit this category and in a way slowed down the depletion of that inventory. From where we are today, and again, it's not that we have very clear visibility into the channel inventory because this market has multiple layers till you actually reach the end customer, unlike retail. We're of the belief, and based on our check, that the levels of inventories are much, much lower than where they were when we started last year, meaning inventories are much, much closer to normal levels. And so right now, we don't see inventories or excess inventories as an issue for the execution during this year. And we believe that with the good pipeline of new products that are now in mass production, we are well positioned for revenue growth this year. And that new design win that was prolonged into very late last year is now fully ramped up and in mass production, and that basically builds a lot of confidence in our ability to actually mitigate if there will be any weakness with growth in this category throughout 2020. And I think that during this year we are very hopeful that we'll be able to secure even more lucrative sockets that will, in a way, fuel up our expectations and our ability to outperform also in the next couple of years.
Okay, that's very helpful. And then just as a follow-up, I think last quarter non-smartphone applications within smart voice was over 70%. Curious what it was in Q4 and if you expect that sort of composition to remain relatively stable in 2020.
Yes, so with respect to the smart voice product composition, smartphone versus the non-smartphone categories, I believe that for the year, for 2019, it was roughly a 25% smartphone and 75% non-smartphones. and actually the 75 was quite evenly allocated towards tablets, cameras, and entertainment. These are the TVs, remote controls, and the over-the-top products. And if I look at Q4, I would tend to assume that it was, shy of 20% to smartphones and about 80% for non-smartphones. And, smartphones will fluctuate depending on their launch date, and usually the life cycle is fairly short per model. So I think there will continue to be fluctuations also this year. But I would assume that it will be about a 20-80 split in favor of the non-smartphone side. We believe that we are actually building a lot of franchise businesses, as you saw, for instance, in the entertainment side, as well as on the camera front. And the tablet side, we believe there's a lot of value and a lot of ability to grow and to see many more products incorporating these capabilities. And I think that the next pillar of this growth over the next 3 years, a lot of which will be around the AI, so audio analytics or audio AI on the edge. And I think that there will be a lot more value that will be driven there. And on the smartphone front, I believe that, audio analytics and the capability to replace a lot of sensing elements inside the phone with the acoustics, this will be a major value proposition that will be well beyond whatever you can do with wake on voice and always listening elements, the ability to do that at ultra low power, the ability to create a lot more value while, supporting all of the new requirements for smartphones of, an edgeless screen and the lack of ability to install any hardware on the front of the device itself. So with that, we believe that our smart voice franchise will continue to play a key role in our growth going forward.
Okay, thanks a lot.
Thank you. And your next question comes from the line of Charlie Anderson of Doherty & Company. Please go ahead.
Yeah, thanks for taking my questions. Couple of ones on the guidance real quick. It looks like based on how much growth initiatives will be as a percent of revenue, that cordless will actually be up both sequentially and year over year. So I wonder if you could maybe touch on what's going on there and maybe how that impacts the rest of the year if that's up. And then secondarily on the R&D, thank you for the commentary that it'll go back to more normal levels the rest of the year. But I'm just kind of curious, what was the boost that created the larger level in Q1? Thanks.
Thank you, Charlie. So maybe we start with the latter part of your question first. So with respect to R&D and OPEX, as Dror commented, we believe that Q1 will be temporarily high, mainly because of certain tape-out expenditures that we have, and we're basically doing a tape-out during this quarter, and this will basically take the Q1 R&D expenses to be higher than average, and they're expected to go back to normal. So these are more on the NRE front, the non-recurring type of expenses. So this basically takes care of the OPEX and R&D expenditures in Q1. And your other question had to do with the guidance for Q1 and where cordless is. So cordless will fluctuate, and again, there's very little control or that we have vis-a-vis kind of the trend line there. I believe that we're modeling, and I think you guys should also model, this decline in the 15 to 20%. So right now, we do not see a change in the level of declines, and yes, there will be fluctuations. As you can appreciate, last Q4 was artificially low, and in a way the recovery was slow. Maybe that's kind of the mismatch with respect to the year-over-year comps. So it's just like an easy comp in Q4 and also Q1. But I don't see a change in the trend. I think that what we are going to see this year is further increase in the proportion between the growth initiatives that should trend into 70-30 type of a mix, or maybe more than that. I think these are the trends that we are expected to see this year, and there will be these kind of quarterly fluctuations that are it's very hard to kind of understand why in Q1 we actually see good momentum in cordless and good backlog, but I have no real explanations for that. I can only allude that what we believe is that 15 to 20% decline is the right way to model this going forward, and growth across our growth initiatives for the year, and this is kind of how we see expansion, growth margin expansion, and we believe that the healthy trends should also continue in 2020.
Great. Thank you so much for that, color. And then for my follow-up on unified communications, I know you have the large win for this year, but it also sounded like you're optimistic of potentially a few others as well. I wonder if something has changed in the pattern in terms of replacement cycle there, in terms of you guys replacing incumbents, or is it just so happened that things have sort of lined up well in the past 12 months? Just any commentary on sort of the trajectory of that business over time. Thanks.
Sure. So on the UC front, I do believe that we have seen a lot of changes in the market. First of all, we've seen the UCaaS, or the SIP trunking, or the unified communication as a service, becoming a major part of the market, and we see a lot of disruption there with new service providers, both for rich media and collaboration solution, as well as endpoints, a lot of new endpoints elements, from headsets to other conferencing solutions for personal, desktop, in-room conferencing, etc. So there is, I think, a lot of investment and change that is driving the market, and perhaps also creating some opportunities for companies like us that have been investing in this market and today have the most comprehensive product portfolio and technologies that in a way meet all of those requirements. And I think that we are really today the one-stop shop for this market, for any vendor that is looking for a high-quality, high-performing solution. So what we are doing is, in a way, making sure that we're supporting our partners, our customers in this domain, and enabling them to upgrade and build new capabilities, better voice quality, better video quality across the solutions. And as we've seen, this has been a long tail type of a market where design and refreshes tend to happen once every couple of years, and we've waited patiently, and hopefully a lot of that will pay off for us in the near future. So we're, I would say, very optimistic, and we believe that we have all the right capabilities and merits to win the sockets that will be available for refresh.
Great. Thank you so much.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone keypad and wait for your name to be announced. Your next question comes from the line of Raji Gill of Needham & Company. Please go ahead. Raji, your line is open. Please, can you check you're not on mute? Okay, moving on to your next question from the line of Suji Desilva of Roth Capital. Please go ahead.
Hi, Ofer. Hi, Dror. Hopefully you can hear me. The non-smartphone smart voice, can you rank order the top 2 or 3 revenue contributors you expect in that segment in 2020, and which ones are maybe growing the fastest to help us out with?
Hi, Suji. I think the question was around the main contributors in the smart voice segment, right?
Right, outside smartphones. Yeah.
Smart voice outside smartphones. Yes. So if you take the $19.3 million that we generated in 2019, about 25% of that was smartphones, so 75 was non-smartphone. And in these sockets, in a way, we have three key franchises. One is the entertainment side, which includes TVs, remote controls. This is, close to 25%, a little bit shy of 25% of revenues. Tablets are around 20% of those $19.3 million, maybe a little bit ahead of that. Cameras are about 25%, and then we have other IoT, the other IoT category that will include smart speakers and the hearables, etc. I think that when we look at 2020, we do expect hearables and wearables to become a more meaningful part of that business and to start generating revenues there as well. And that we hope to make it one of the kind of the key 5 categories, including smartphones, entertainment, tablets, and cameras. So I would say these are kind of the 5 categories that today we're focusing on. Our roadmap is targeted to solve a lot of future issues and provide a lot of capabilities and value-added solutions, as we discussed, in terms of AI on the edge, the ability to really drop the power consumption considerably while elevating the performance, the ability to conduct far field in very high quality using a battery power device, the ability to run a lot of machine learning classifier in the same time, on chip, on a battery operated device. So all of that, I think, should bode very well for each of these 5 key categories that we're focusing on today. So I hope I answered your question, Suji.
You did, Ofer. Thank you. And then the inclusion of AI as a feature there and AI at the edge, that kind of upgrade, if you would, is that an incremental revenue or ASP opportunity? Is that just a kind of feature upgrade that keeps you in these platforms? And when does that layer in, or is that really already being used by the customers?
Yes. So first of all, it does basically increase the content, so it does raise the ASP for the devices that we're in. I think that also, whenever there's a dilemma between, just running software versus, running it on a dedicated ultra-low power machine learning type of a chip, then the more capabilities that such a chip can provide, the higher the likelihood of the selection of a dedicated a processor just for that versus, running software on the AP. And today we do have, and we are running these AI on the edge capabilities, the ability to do, sound event detection and audio analytics are running today in production on our chipset.
Okay, great. All right, thanks, guys.
Thank you. Once again, it's star 1 to ask a question. And your next question comes from the line of Ari Shwistrom of Needham. Please go ahead.
Hey guys, good job on the quarter. So this is Ari taking the question for Raji Gill. And my first question is about your unified communications business. Can you talk about where you're seeing the business go this year, and a bit about a design win pipeline in this business? Thank you.
Hi, Ari, and thanks for the question. So on the unified communication business for this year, I believe that we are optimistic that we are going to outperform this year. I think, we did see the shortfall that we experienced in 2019 due to the trade war, as well as the lower demand, mainly related to business IT spending. We believe that today, with the additional wins, with the additional products that we're shipping, we're well positioned to be able to generate a nice revenue growth from the UC product segment. I think that when addressing some of the comments that were made earlier, we believe that the inventory levels are today at closer to normal levels versus the significant or excess inventories that we saw just a year ago. So by looking at all the fronts, we do hope and believe that we are positioned well for our performance and revenue growth in this business, mainly coming from our ability to ship and win a lot of new products that are shipping this year that were not in last year. So just these are creating the revenue growth for us. And I believe that they will be able to absorb, even if there will be certain hiccups, which right now we don't anticipate, but we believe that the traction and our ability to generate revenue growth in UC this year, the chances are very, very good, and we're very optimistic.
Yeah, and as my follow-up, I wanted to ask if there are any new markets or verticals that you plan to target in the future that you believe would be beneficial to further growth and margin expansion, and whether this be through M&A or through organic means targeting new verticals.
Ari, I'm sorry, but we had some problems hearing you well, so can you repeat the question, please?
Oh, okay. Yeah, so I was just asking if there are any new markets or verticals that you plan to target in the future that would be beneficial to growth and margins.
I think that from new market penetration, I believe that today we are focusing on the three segments of smart home, with everything that comes behind under this umbrella, IoT, consumer, service provider, professional, as well as industrial. Unified communication, which is the professional business market, smart voice, which also includes a broad array of many different consumer electronic products. We mentioned, I think, and also demonstrated a lot of capabilities around hearables at CES, which you saw from glasses to headsets. And I believe that this will be as a product category. I think this product category will hold a lot of potential growth, and the need to incorporate a lot more technology in order to create more differentiation in the market. And I believe that DSP Group is well equipped with very relevant technology to meet the market requirements. We are serving for many years the markets of low power, voice, the ability to do low power processing or value added, to do sensing capabilities. So, if you're asking about the new product category, yes, that definitely hearable does look as a promising new product category for us, and we believe that we will be able to serve it with several of the new products that we have launched and that you've seen at CES.
Thank you. There are no further questions at this time. I would now like to hand the call back over to Tali Chen.
Thank you. During the fourth quarter, DSP Group will participate in the 32nd Annual Roth Conference on March 15 to 17th in Orange County. Thank you for listening in and for your interest in DSP Group, and we look forward to report back to you in 90 days.
Thank you, ladies and gentlemen. That does conclude your conference for today. Thank you for participating, and you may now disconnect.